A smarter mortgage is about saving time and money. And it's also about having the flexibility of early repayment and certainty of cost. At the moment, the challenges I'm seeing are for people who've got less than 20% deposit. There's been some changes in the lending market where the Reserve Bank has forced banks to actually hold more capital. So what that actually means is they're now needing people to actually buy a house with more deposit. And for the last 6 or 7 years, I've been helping first-time buyers buy a house with 10% deposit from KiwiSaver and maybe a little bit of help from mum and dad. But right now, the banks are wanting 20% deposit or else no deal. So there's been legislative changes to something called the Credit Contracts and Consumer Finance Act. There's even a petition that's going on about it. So what that means is banks are being forced not to trust what you tell them, and they're asking for more information from people, and they're not giving the flexibility that they might have provided previously around lending applications. So it's actually making it difficult for advisors, it's making it difficult for clients, and it's even making it difficult for the assessors at the bank. So there's actually petitions out there to try and force the government to actually change that policy that's actually been put in place. So it's really meant the two kind of types of buyers that are around at the moment, or that would have been around, first-time buyers and mum-dad investors, are finding it really difficult to get a property or a home because of the level of detail they're being asked to provide, like whether they're going to have a baby, whether they're planning a family, whether they're planning to still dine out after they've bought, their property. And a lot of people have actually been paying more in rent than they're actually going to pay in a mortgage. And some of that's due to the lowest interest rates for a long, long time. So the bank of mum and dad is mum and dad giving their kids some money. The terms of the giving can actually be that they've given it as an early inheritance, never to need repaying. Or they may actually give it on the basis that the children need to repay it in the future when they sell the property. Mums and dads may give the money from cash that they have, and often they may even be topping up on their own mortgage or property to actually give that money to their children. There are some major tax liabilities now as a result of legislative change that mums and dads need to get accounting advice and legal advice about, and that is not from me, it's from a specialist in those areas. But mums and dads need to be really careful at their age and stage of life that if they are giving their kids some money and that's repaid, they're potentially up for some tax liabilities, and they just need to be really careful about helping their children but looking after themselves and their estate. One of the things I tell my clients about interest rates is they're relevant when you've got an unconditional purchase on a property and it's going to settle and you're locking in the loan structure. Otherwise, it's crystal ball gazing because they could go up and they could go down. And the reality is right now in the market at this time, they're starting to rise after the lowest interest rates in 30 years. It's not something I really like talking about, but it is relevant when you have a mortgage. So the story that I like to tell is about me personally. I had a mortgage of $665,000 and it was on a fixed term that was expiring. I had an advisor at the time who didn't actually, ironically, give me what I determine is probably the best advice. So my mortgage came off its fixed rate. I refixed my mortgage, the whole portion of my mortgage, and at that time the interest rates were 9.25%. And it was not 100 years ago when my mortgage was $22,000, which you hear about from people. My mortgage was $22,000 and interest rates were 15%. I'm talking hundreds of thousands of dollars. It was the worst year I've ever owned property in my life. And the advice I didn't get was to spread my risk. And I got asked today what that means. It means splitting up your mortgage into pieces. Now, if you really want to know how to do that, you have to come and talk to me because I'm not going to tell you. My top tips for people trying to buy their own place to call home are firstly to spend less than you earn, because that is super important so you've got some surplus left over. Minimise short-term debt because that can massively affect servicing. Have a budget so you know what your income is, what your expenses are and what you've got left over. Then put some aside for savings and then you know what you've got left over for fun. And my final tip is know your numbers. What's your income? What's your deposit? And what is your short-term debt?